Assalamualaikum. Hi everyone. I'm going to continue with the second part of my lecture on the investment property. First of all, I'm going to continue just a little bit more on the fair value model. Basically, in the absence of a current price in an active market, the entity could use the current prices in an active market for similar properties. So if the fair value of a property cannot be determined in an active market, an entity can refer to the current price of a similar property in other active market. Or the entity could also use the recent prices of similar properties or discounted cash flow based on reliable estimates of future cash flows. Alright, next we go to inability to determine fair value reliably. Alright, so if the fair value of an investment property under construction is not reliably determinable, the cost model should be used until either its fair value is reliably determinable or construction is completed, whichever is earlier. Alright, and if the fair value is not reliably determinable even after construction is completed, the property shall be measured based on the cost model in MFRS 116. So this is for investment property under construction. Alright, and then if the fair value of an investment property is not reliably determinable on a continuing basis, the cost model in MFRS 116 should be used. Alright, next we go to the transfers to or from investment property. Transfers here mean change of use. Alright, basically there are four conditions of transfer. The first one is the transfer from MFRS 140 investment property to MFRS 116 PPE. Alright, so for this type of transfer from IP to PPE, the accounting treatment is like this, right? So the fair value will be used at the date of change, and the entity should apply MFRS 116 from the date of change. So this is the accounting treatment for the transfer from IP to PPE. All right. For the second transfer, that is from MFRS 116 PPE to MFRS 140 investment property. So the accounting treatment for this transfer, the fair value should be applied at the date of change, and the fair value will be compared with the carrying value at the date of transfer. Any difference is to be accounted in the asset revaluation reserve, and the subsequent treatment will be based on the MFRS 140. Alright, and for the third type of transfer, that is from MFRS 140 investment property to MFRS 102 inventories. So for this transfer, the fair value should be applied at the date of change. For subsequent treatment, the entity should apply the MFRS 102 for inventories. And for the fourth type of transfer, that is from MFRS 102 inventories to MFRS 140 investment property. Alright, so the accounting treatment for this transfer, the fair value should be applied at the date of change. Any differences in the carrying amount and the fair value will be accounted in the income statement. Alright, so this is about the transfers or change of use. Alright, basically assets like building and land may undergo changes in usage. For example, a building used for administrative may later be rented out. Or a building used for use or held for rental, may be later be used as an administrative office. Alright, let's have a look at this one. This is a transfer from MFRS 140 investment property to MFRS 116 PPE. Okay, so the accounting treatment for this transfer, at the date of transfer, okay, the value used will be the fair value of the property. Okay, subsequently, the treatment will be according to MFRS 116. Okay, let's have a look at this example. KL Berhad purchased a property costing RM 9 million on 1st January 2011. The property was rented out to OMG Berhad at an annual rental of RM 250,000. Okay, the rental has been negotiated at arm's length. Okay, on 1st January 2012, the property was vacated by OMG Berhad, and KL decided to use the property as administration office. Okay, the fair value of the property at that time was RM 10,500,000. Okay, assuming KL Berhad adopts the fair value model in its measurement subsequent to the initial recognition, discuss the accounting treatment of the property for the year ended 31st December 2012. Okay, so what would be the answer for this question? Let's check out. Okay, all right. So the answer for this question, under MFRS 140 investment property, on the date of the transfer, that is on 1st January 2012, the owner occupied property will be measured at the fair value of the investment property of RM 10,500,000. Right? And the difference between the fair value at the transfer date and the previous carrying amount of RM 1.5 million, okay, that is 10,500,000, okay, the fair value, minus the initial cost 9 million, okay, is recognized in the statement of profit or loss as fair value gain. All right, and from here onwards, the property shall be depreciated over its remaining useful life. Right, so if an entity, all right, so let's have a look at the journal entries. Okay, look at the journal entries here. All right, so on 1st January 2011, that is on the date of purchase of the property. Okay, we have to debit, okay, the investment property 9 million, the initial cost. Okay, credit cash, okay, or payable 9 million. Okay, and for 31st December 2011, okay, that is on the date of change or date of transfer, or the date can also be 1st January 2012. Okay, actually the date of transfer is on 1st January 2012. Okay, so we have to debit investment property 1.5 million. Okay, this is to increase the value of investment property by 1.5 million in order to reflect its fair value. And then we have to credit SOPO fair value gain, okay, amounted to 1.5 million. And then on the same date also, we have to debit PPE at fair value, at the fair value of property 10.5 million. Okay, and we have to credit the investment property 10.5 million. Okay, so we have to write off the investment property since it has been changed to the PPE. All right. Okay, next we go to another type of transfer, that is from BPE MFRS 116 to investment property MFRS 140. Okay, so the accounting treatment for this transfer is that at the date of transfer or change, the value used will be the fair value. Right, the fair value will be compared with the carrying value, that is cost minus accumulated depreciation at the date of transfer. Any surplus is to be accounted in revaluation reserve and deficit to the SOPO. Subsequently, the treatment will be according to MFRS 140. Alright, let's have a look at this example. Okay, on 31st December 2012, Boleh Berhad vacated a building in Shah Alam which has been its administrative center and moved to a new building in Putrajaya. The former building has carrying value of RM 5 million and is now rented out to 4 tenants. Okay, the fair value of the said building is RM 7 million and is treated as investment property under MFRS 140. Okay, on 31st December 2013, the property has a market value of RM 7.5 millions. Okay, so let's have a look at the journal entries, okay, for this transaction or for this situation. Okay, on 31st December 2012, that is on the date of transfer. Okay, we have to debit the investment property. Okay, investment property, since the property has been changed from PPE to IP. So we have to debit the investment property building at its fair value 7 million. And we have to credit the PPE because the PPE has to be written off. Okay, since it has been changed to investment property. Okay, so we have to credit PPE by 5 million and we have to credit the asset revaluation reserve. That is the difference between the fair value and the carrying value of the property. Okay, so the difference has to be credited in ARR 2 million. And on 31st December 2013, as we know, there is an increase in the fair value of the property, okay, by 500,000 or 0.5 million. So we have to debit the investment property 0.5 million and credit SOPO fair value gain 0.5 million. Okay, so that is the difference between the fair value, the current fair value, and the previous value. Okay, so we have the fair value gain amounted to 0.5 million. All right, next. Okay, this is about the disposal of IP. Okay, so investment property is eliminated, okay, or derecognized, okay, from the balance sheet on disposal by sale or by entering into a finance lease, or when it is permanently withdrawn from use, and no future economic benefits are expected from its disposal. Okay, and the difference between the net proceeds and the carrying amount, okay, that is the gain or loss on disposal, okay, will be recognized in the SOPO. All right. And the last one, this one is about disclosure. Okay, I think for this one you can read by yourself. Okay, the most important thing is that you need to know how to disclose the information about the fair value gain or fair value loss or depreciation of the property in the SOPO. Okay, and to disclose the carrying amount of the property in the SOPI. All right. Okay. So that's all about investment property. Thank you very much. Okay. Assalamualaikum.